Now moving to the C5s.
Moving to the C5s, finishing on a low point, actually, on your program. Sorry, mate. Two C5s here, Transurban. Interesting because Canadian pension funds are interested in this.
But they've dropped out recently, haven't they?
Yeah, my response to that is, you know what, some wacky people live in all different countries and they're willing to pay all sorts of prices for assets.
Yep.
This is a C5, this is a low quality business.
Now what's wrong with it?
Well, it's debt to equity 113% and its
you
return
hate
on
debt,
equity.
don't you?
Its return on equity for the next 3 years won't rise above 3%. I can get 8% in a 5-year term deposit. Why would I take the risk on of owning a business with a lot of debt? Even if its cash flows are stable, the reality is it's geared to the hilt and I'm just not interested. So that's that one. And the other one, Primary Healthcare. Primary Healthcare scores a C5. Its return on equity for the next 3 years expected to be about 7%. Again, pretty low. Its debt's quite high, but its performance is not that good, and its value is much, much lower than its price.
Now, let's go back to the fact that you made a point earlier where you said you want little to no debt. Are you trying to say that there are companies out there with debt that don't do well with debt?
You're being facetious.
I'm being very facetious because you know there are good companies with debt and they do really well.
Gearing, it's the same as borrowing to the hilt to buy a property. You and I borrow a lot of money. If the house price goes up, we'll do okay using other people's money. But if the house price goes down, there's not much margin of safety for us, and it's all going to go pear-shaped very, very quickly. It's the same with companies that borrow money. If a company borrows a lot of money and its revenue looks good and it's getting more customers and its expenses are under control and interest rates don't go up, well, things are going to look rosy. But as soon as interest rates go up and as soon as revenue starts to flounder for any reason, then you're going to see a hit to the EBITDA line, and then you're going to see a hit on the interest, and the impact on profit after tax will be exponential. If the company stays at a constant PE ratio, the share price is going to plunge a lot more than a company that had no debt.
But Roger, when you say little or no debt, it doesn't mean a company can't have debt, but you actually...
I'm saying I prefer companies with no debt. And there's plenty of them. I remember in 2004 I bought the Reject Shop at $2.40. It was earning a 40% return on equity with no debt at all. It's now got a little bit of debt, but it's generating a 70% return on equity, and it's 3 to 4 times the size. The share price has gone from $2.40 to $17.
Okay. Now, you've also done an interesting comparison between Myer and Harvey Norman. I have. And that was something we talked about last time.
We mentioned that last time.
We have been accused by your assistant of not keeping our promises sometimes. So this is a great opportunity to keep a promise.
So when Myer floated at $4.10, my apologies to anyone who didn't know that I very publicly on all the networks said it was expensive.
The Myer hitman is following you into car parks, you know that.
well, they've run off with the Myer hitman's not employed anymore because the guys who employed him, they've gone. They've taken their cash. This is a business that generates an okay return on equity. But the return on equity and the equity that it has and the intangibles that it's got on its balance sheet means that its quality is not as high as I would like. It's low. And because the quality is low and because the intrinsic value is not going to go to $3.90 for 5 years, and its intrinsic value today is about $2.80, $2.70, $2.80, thereabouts. That's what I think Myer's worth. Rising to $3.90 in 5 years' time, well, to me, that's what's that, 3-4% per annum increase or thereabouts in intrinsic value. That's not a good clip. It's not an attractive increase.
Considering what you get in fixed deposits, which is often your comparison point.
So I'd rather buy, some of these A1s whose intrinsic values are going up at 15% a year if I can get them at the right price. So if I compare that to Harvey Norman is an A3. It's not an A1, but it's certainly not a C5. It's an A. It's a high-quality business. Its performance is relatively predictable. Its return on equity is lower than Myer, but its intrinsic value is currently $3.74 going to $4.85 in 2 years' time. So that's a reasonably attractive increase.
And we're sitting around what, 350 or so now?
Well, yeah, and the value's 374, so it's trading about there, 370 or thereabouts.
Yeah, so for our viewers, if you're right, and we doubt whether you'd ever be wrong, Roger.
Oh, no, I can be wrong.
Okay, well, tell us when you'd be wrong. This is an interesting part of your... When can you be wrong?
Everything about these intrinsic values that I'm giving you will change when more information comes out about a company. So if a company announces an upgrade, a downgrade, an acquisition, it borrows money...
Something from left field.
Tats goes and buys New South Wales lotteries for $850 million.
Tats losing their licence.
in 2012 in Victoria.
Yeah.
So any of those things can happen, come out of left field, and that's going to change the intrinsic value of a company. That's why it's really important to stick to industries that are relatively stable rather than fast-moving industries and fast-moving companies. For example, technology companies, fast-moving, biotech type businesses, pharmaceutical businesses, fast-moving. Someone can come up with a new wonder drug, and they've been busily building that thing for 5-10 years in secret, and they launch it and it wipes out the competition. So there's sorts of things that happen quickly, very hard to predict. So that's where you can get it wrong, but that's why you want a big margin of safety, and you want to buy good businesses when there are big discounts to intrinsic value. You're going to do pretty well over long periods of time if you just do that consistently.
Okay.